Okay. All right. We are live. We're live with Ted Jenkins. Ted, man, where are you at in the country? Are you in Atlanta right now?
I'm in Atlanta, but I got my Pebble Beach jacket on, so I'm comfortable.
Dude, living the dream, man. Living the dream. Well, we're gonna let a couple people trickle in, but excited to jump on this live stream. People can go ahead and send questions and in as we go. But as we always do, we're gonna talk about some great deals that you've seen going on. We're gonna talk about what the market's done to these deal flows, if this is a concern, and then things, Ted, that you see that guys need to be planning out years in advance. Like if they're saying, hey, I'm gonna exit in a couple of years, like what do they need to be thinking about now versus like calling you saying, hey, Ted, can you get me a check next week?
I feel like I'm on 2 riversides. Hold on one
You
second.
might be. You might be.
Hold on.
It says you're
Alright, we're
somewhere
good
else
we're good
too.
now.
We're good. We're good.
Yeah. We all had
Perfect.
technology issues today, Jarvis. It happens.
It's good stuff, man.
Yeah, so hit me
Dude,
up here.
yeah, dude. So now tell us about some deals you've seen recently. I know, in fact, I've even got your website here. I'll throw it in the chat here. You've got a list of deals that you've seen come up. Let's see if it'll let me share my screen and maybe walk us through a couple of these. Walk us through what it is you're seeing in the real world. I mean, the way that you and I first met is you went on the Kids Us podcast, and I said, "Oh, these numbers have got to be BS that Ted's showing," and then you're like, "No, dude, I'll show you the numbers," and it was all real.
Yeah, in fact, I had the funniest thing today. I had somebody from FP Transitions tell me that my numbers were bullshit too, and that I shouldn't be putting these fallacies out on the internet.
No
And
way.
I said, "Do you mean like facts or fallacies? Like you might be getting your words confused that they're facts." I'm sorry that FP Transitions is, and no offense to them, and they're a great
No,
company. I
huh?
just don't think they understand what the market is. But this is just a great example here on the left-hand side where it was a practice that was basically 90% RIA, hybrid, 10% broker dealer. You know, frankly, Jarvis, a lot of people in the broker dealer world, really the only thing I feel like they're selling are like variable annuities still. It's just, it isn't REITs anymore. There's a couple of legacy 529 plans. Maybe every once in a while, you got people that roll structured notes, and do that in a brokerage account as opposed to a wrap account. But
Sure.
this one in here was a 90-10. Basically, you can kind of see a lot of the ratios are basically 1 to 1, 400 million to about 4 million of revenue. And this offer was about 6 times. Now, the way that this shook out is it was 65% cash at close, meaning the day that they closed, 65% of that 24 million, boom. Talk about a wire, Jarvis. Unbelievable.
Wow. That's incredible.
97% capital gains, 3% ordinary income. Another 15% was on a rev retention, meaning after 12 months, is your revenue at least at 95% of the revenue that you gave them the year before. And I want you to think about this. You can make these market neutral. This is what most advisors don't realize you can negotiate. Right? Do I negotiate with the markets working for or against me? Or do I negotiate market neutrality? Now, I'm giving
Interesting.
away gold
Yeah, no
on this
kidding.
podcast right now, only on Jarvis's podcast while I do this. Gold, I'm giving you away because you would never know to negotiate market neutrality, and that you can bifurcate that negotiation within a contract, meaning I might negotiate market for me on my earnouts that might be 2, 3, 4 years out, and market neutrality on 12 months, right? Because if any of you
Crazy.
think you know what Trump's going to do right now, you're a big fat liar. He didn't even know what he's going to
He
do.
didn't
So
know.
what does that
Yeah.
mean?
Yeah.
Doesn't mean you know what you're going to do.
He's making it up today. Yeah.
Then what happens is where people don't understand this in reality is like, how do these firms pay a 6x on revenue? Well, the way that they do that is to have some expectation of growth in the business. And by the way, this is true. I saw other companies besides financial advisors. It's true on all businesses. So
Hmm.
generally think about a 10% CAGR, meaning that in this case, the revenue's got to grow by at least 10% per year over the next 3 to 4 years, which honestly, if the market does 6, Jarvis, or your portfolio does 7, I love how advisors say all the time, I'm a great money manager. And I'm like, do you think you can make 10%? Well, I can make at least 8. Okay. Then you only need 2% growth. You really,
Yeah. Yeah.
you
Get a
got to
couple
acquire
referrals and
like,
you're good. Yeah.
yeah, acquire like 3 clients on a sidewalk with a sandwich board and you'll be fine. It's not that hard. And by the way, what these offers do not include is the ongoing compensation. This advisor is getting 30% of the revenue with no expenses on an ongoing basis. It doesn't include the growth in the stock. This deal was an 80-20, 80 cash, 20 stock. I believe the stock will recapitalize at a 3 to 4x over 5 years. And there's a retirement plan at the end. So this is just straight up for the deal, 6x on cash and stock.
Yeah, I think, and Ted, obviously you know this, but for our listeners, right? I hope everybody's picking up. There are so many levers to pull in these deals. Like the headline is multiple on sales price, whatever that is, whatever that means. But you're talking about earnouts. You're talking about, is it market neutral or is it not? What about the ongoing compensation? What about a retirement plan? What about the company equity? I mean, there's got to be dozens of variables, and we haven't even talked about like the due diligence or how you're presenting it or how you're matching up buyers.
Yeah.
Like, these are just deal terms.
I think you're making an important point, which is that we read and hear and see all these numbers in trade publications.
Yeah.
So the first thing you want to ask yourself, and I want you to think about this, when you look at enterprise value, folks, I would look at a very simple equation: X times Y equals Z. Now, Z is the enterprise value. Like, what's the practice worth when you sell it?
Sure.
And X is really what's the number that they're using, and Y is the multiple. So let me go through an example. On the X part of the equation, are they using EBITDA or adjusted EBITDA? Are they using EBOC, the real cash flow to the owner? Are they using revenue? Because somebody could say, I got a 14X. Well, that 14X might have been on a after owner salary adjusted EBITDA. And somebody else says, I got a 7X. And they say, well, that sucks. And your 7X was on revenue. So the question is, the multiple is of what? Of what are you multiplying by? Because I've seen multiples at 16X on cash flow. I haven't seen a multiple yet, Jarvis, above 9 on revenue. Now, I did see an 8.8 the other day on a very, very lucrative fee-only RIA. But it's, you should just ask yourself, it's a multiple of what, so you don't get confused on what you're reading.
Ted, this makes me feel like, and you and I have been in the industry a long time, makes me feel like the heyday of variable annuity living benefits, where it's like you get 2/3 of one and 4/3. And so like the thing is like guaranteed income for life. And you're like, oh man, this, and then you like peel it back. It's like, well, it's going to be all in bonds. Right. And it's going to follow some weird index that no one's ever heard of. It's actually never going to make money. But it's a big headline.
Did you know that Prudential could automatically recalibrate your portfolio when we don't get where we need to go? I swear advisors still can't explain those products.
No, I don't think anybody can. You look at the formulas. You ever looked in there? I know you have. Like you thick through the the documents for it, and it has like the actual math formula for how they do it. And some like Albert Einstein equation. You're like, nobody knows what the hell this means.
They're only one slider easier to explain than like an IUL or a VUL. They're even harder to explain, because people are like, hey, you can borrow and it's not going to cost you anything. It's like, did you read the contract?
Yeah, well, and I guess, to pull on that thread a little further, like if you're buying yourself a VUL or IUL or whatever the hell you're buying for a little piece of your money, like that's fine. But we're talking about the single biggest transaction of your lifetime, right? Yeah. And for most advisors, and Ted, you've seen a lot of these, what is this, 90% of their net worth, 95% of net worth? And like, we'll see what we do.
Well, I think let me explain one of the other ones on here, and then I'll give everybody a little food for thought, okay? Because I'm thinking that what you do for a full-time job, because I used to do this, is you do financial plans for people. You build out how much money they need to say bon voyage one day, what kind of rate of returns that they need. But I'm actually surprised about how advisors don't think about how to build their own net worth or how to analyze the best financial decisions to build their own net worth. Because you see on your screen here an $846,000 revenue at 5.8 million. And somebody could be looking at those two deals and go, how in the hell did somebody that does 3 million less revenue possibly get a higher multiple? How?
Yeah.
And the answer is that you ultimately, if you don't know how to negotiate these, you're going to get crushed, can decide how you want to build air in the balloon. What does that mean, Ted? Well, everyone should understand the concept of the time value of money, and also understand that something is worth more if it can grow more. So imagine that in that CAGR number I gave you at a 10% hurdle, you said, man, I'm a great marketer. I think I could grow at 15%. I could grow at 20% a year. Well, if you're giving a company a higher growth number and you're giving them a longer period of time to basically pay you out, then you have a chance to basically extract a higher enterprise value for the business.
For sure.
Whereas if you said to somebody, I need all my cash today and in 6 months I'm going to be on the beach, you're probably going to extract a slightly lower multiple. What's ironic is for those of you that have done a business valuation and it says your practice is worth 2 times recurring revenue. One thing I would ask you is, well, if it was worth that, is somebody going to pay you all that today? Like if you die and your spouse is like the executor or whatever and gets the money, is your partner going to pay you out that today? I'm going to tell you there's no way in hell that's going to happen.
Mm-mm.
So it's not really worth that because a dollar today is not worth the same dollar in 2 years. So
No.
we know that. You should know that. And it's like, this is all part of the nuance about thinking about a negotiation. What's the value of my business? What kind of ongoing compensation should I get? How much should I take in cash? How much in stock, if I take stock at all? And can I negotiate a third bite of the apple that if I grow this business, there's something more for me or my employees down the road?
Yeah. Interesting thing I want to pull on there, Ted. You mentioned, what's the value of my business, and you've shown some great multiples. But if somebody just has like, a broken toy, they just have like a book of business that they haven't called, that they're old, like you're not just going to get some of these multiples 6x, 7x, 8x. Like you're still like a book of business walk away. Like your example of a guy dies and somebody's going to buy. Like maybe you're going to get 2x. Like this isn't like there's free money floating.
Maybe. I've seen a
Maybe.
lot worse in this industry.
Yeah. Well, for people that aren't familiar, like you've been in the industry a long time and on multiple channels, you've seen a lot of deals come and go, not just the ones you've brokered and not just your own deal, but you've
Yeah.
seen a lot of sides of this.
I'll make you laugh here. Maybe
Yeah,
not. I
please.
like making Jarvis laugh. Here's the thing.
I'm
In every
sorry.
one of your towns and cities, you get some doofus on a billboard that says, buy your house
Yeah, yeah,
guaranteed, right? Every
yeah.
single city. Now, what does that mean? How could someone guarantee that they're going to buy your house, right? Because I still have to have a way to be able to sell it. What if I said to every one of you that are on here today, I will guarantee you that I buy your practice for 5 times revenue? Would that sound pretty good?
Sure. Yeah.
Sure, that's right. Everyone who's on here is now like nodding their head, like, yeah, Ted, that sounds great. What I didn't tell you is how long it was going to take for me to pay you. So you said yes, and I shake hands with you. Then I tell you I'm going to pay you on a 10-year seller note.
Oof.
10 years? Well, gosh,
Yeah.
Ted, that's a long time. Well, you didn't ask me. You just said
You
you
didn't
wanted
ask
a
that. Yeah.
guaranteed 5X. I just guaranteed you 5X. I didn't lie to you. I did not tell you the truth. So the thing of it is, if you don't ask the right questions, then as a financial advisor, and you're going to have to do this for some of your clients when they sell their business, whether you're a SEPA or not, you've got to be able to determine the real value of the deal, right? And
Yeah.
this is what has made us so good at JPTD, is that we've done deals with so many companies, all your big boys and girls that are out there. We now have 100 buyers, right? And I'm not talking about somebody who's going, Mom, can I get a loan? I got to buy a practice. I'm not talking about that. I'm talking about people that have real money that are ready to write a big check today.
That's an important distinction, Ted, because I'm sure you do too. I get calls from advisors all the time. I think I had 3 this week already. Hey, Jarvis, I want to buy a practice. Well, cool. How many have you bought? Well, I haven't bought any yet. Well, do you have financing lined up? No, 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 I don't. I'm just going to call the bank. Like, no, 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 no. That's not going to work. A, you're not going to get financing. B, no one's going to sell to you. Like, there's so many really good buyers that you can't just be like, hey, we'll buy houses for cash, and someone's going to line up on that
Right.
one.
Well, it's even funnier if I ask them the next question, which is, what's the structure going to look like? I don't know. I got to look at the client base. Like if the average client is 72, I might pay less. And you have 5 clients in Washington and 3 in Arizona. That's going to be kind of difficult. And wait, you pay a power planner 75,000. I wouldn't do that. I only want to. I mean, good God, it's like it's easier to part the Red Sea sometimes than 2 advisors to do a deal together.
No, that's crazy. Ted, let's pivot just a little bit. In addition to working with financial advisors, you work with all sorts of different businesses. I feel like every time we talk, you're letting me know some other, what feels to me like a bizarre business you're working with. But every advisor has at least 1 or 2 clients that own a business, not enough that they want to get deep into it. Like it'd be dangerous to try to get into it, but how do they get involved in that? Not just have all the money leave.
You know, I think about one of those things like I wish I knew this when, right?
Yeah.
I wish when I was an advisor, I would have affiliated myself closely with a really good business broker or a really good mergers and acquisitions advisor. And the reason being is that every single one of you will end up having one, two, five clients who have a really good business, and you should be talking to them eventually
Mhm.
about their succession plan or how they plan to sell down the road. The problem is most advisors don't have an extended M&A firm as part of their business. So
How could
eventually the
they? Yeah.
day that your client goes to sell, guess who they're not going to talk to? You. They're going to go to some broker, some banker. They're going to
Mhm.
get down the process. Before you know it, the 30 million you thought you were going to get that you've been working on for 15 years is going to end up at Goldman Sachs, JP Morgan, UBS. I help advisors as their extended M&A firm. And yeah, I sell all kinds of businesses. Right now, I'm working on a roof lifting company. I've got a plumbing company. I just signed on one of the biggest diagnostic medical marijuana labs in the country that does
Oh,
compliance testing, all kinds of businesses. And we now have a private buyer list of 1,200 buyers, family offices, capital
geez.
companies, private equity companies that buy these kinds of businesses and are doing roll-ups, Jarvis, just like they're doing in our industry. In fact, I'm working on a veterinarian clinic in Texas. There are 100 RIA companies in the vet space that look just like big RIAs,
Yeah,
but
yeah.
all they do is they roll up veterinarians.
Huh.
And veterinarians command a tremendous multiple right now, tremendous. So my only thing to advisors is like you're going to look really smart and you're going to learn a lot if you bring somebody along for the ride. And by the way, I get it. I was an advisor for a long time. Of course, we're going to make sure that the assets get deposited into your brokerage account.
Yeah.
That's the idea of the closing stack. Plus insurance sales if you do that or whatever else it may be.
Yeah, because default, and you skimmed over this. Default is the wire from the sale is going to go into the investment banker's account, and then they're going to hold on to that money, right? And they're going
Yeah,
to say,
or
"Hey,
yeah,
you've been
that's
working with
right.
Bob for a lot of years. Bob's a nice guy, and Bob's great if you have 500,000 or a million, but Ted, you got 15 million now, 30 million. Like Bob's not your guy anymore. We're your guy." And then the
Totally,
money's gone. It's never coming.
100%.
Yeah.
Yeah, that's 100% true. And by the way, you'll learn a lot. Like, listen, I took the SEPA course, okay?
Oh
And
yeah.
I'm not telling you it's a bad course. It is a very good course. It ain't going to teach you the block and tackle of doing a deal. Trust me
Mm-hmm.
that, right? When you get two shitbag attorneys that can't agree on something and they're yelling at each other about a paragraph, they don't teach that in the SEPA course. So
Yeah.
you've got to have skilled people that know how to negotiate the deal for the clients and know how to get the deal over the finish line. And we've gotten really good at it. I think that we'll do between 600 and $700 million of transactions this year.
Wow, it's incredible. It's incredible. Ted, we got a question in from Dylan. Dylan, thanks for chiming in here. Any insights on Creative Planning's recent valuation? I feel like that's.
Yeah,
Go ahead. Go
I'm
ahead.
happy to go through this because I studied these numbers. So let me help you all understand why interest rates are irrelevant in our business right now.
Okay.
And let me help you understand when you look at these deals, when you ask yourself the question, how the hell do they make back their money? I'm going to explain this to you, okay? Financial advisor valuations will continue to stay high as long as the valuations of companies like Creative Planning, like Mercer, like
Mhm.
Mariner stay high. So when you read in CityWire that they recently recapitalized at a 23x on cash flow, realize that most normal industries, you never get to a 23x. We're
Oh, huh.
valued really high for three very simple reasons. Number one, advisors never lose clients. It's rare. Even advisors that you think about and go, that guy's a bad advisor. He doesn't lose clients
Doesn't lose
either.
clients.
Right. Number two, most of our advisors in this industry are now fee based, meaning that they have annual recurring revenue.
Yeah.
I realize it's not everybody, but pejoratively, that's where the industry is headed. And most financial advisor practices, unless they're way overstaffed, margin 50% or more to the bottom line. Now, I
Yeah.
want you to think about this. And I've done these businesses: no roofing company, no car dealership, no
No.
coffee shop, no bridal shop, no collision center has those kinds of statistics, which is
No.
why we command a multiple like Creative Planning at 23x.
Well,
How do
shoot,
they pay
most.
you a 12x
Yeah.
on cash flow? The delta between 23 and 12 is what's called to be arbitrage,
It's
right?
enormous.
And when those of you that study things like LBOs and leverage buyouts, where people borrow debt, they buy businesses, they package them up, and they sell them for a bigger number, newsflash, that's exactly what's happening in our
That's what's
industry
going
right
on
now.
right now.
So
Totally.
until multiples come down on CI, Carson,
Fisher, whomever.
yeah,
Yeah.
sure. I mean, then they're just going to stay this way for now. Will they stay this way forever? How the hell do I know? I mean, I'm not going to act like I got a crystal ball. I don't think, the panacea lasts forever, but I have to tell you that forget about interest rates and all this other stuff. It's
Yeah.
the reality is it's about the compression of multiples.
Uh, Ted, as I talk to advisors about this, like everybody's getting as many calls from potential buyers as we used to get from wholesalers. Like I feel like the wholesalers of today are calling with unsolicited offers, and it seems, and I love your experience here, it seems like it's giving advisors a false sense of security. Like, oh man, I got 10 guys call me this week. I could sell my practice tomorrow. Like, I don't think people understand that those are really the bottom fishers. Like, they're not calling you cold to give you some top dollar offer. It's that same like billboard, we'll buy practices for cash, right? Or am I way off here?
No, it used to be in the days of wholesalers and recruiters trying to get you to switch broker dealers or now maybe
Yeah.
switch RIAs or, or whatever it may be. I mean, those calls come all the time. Um, Two realities, right? You just taking a meeting with one company is kind of dumb, right? Because you're going to have nothing to frame it against. So if you're going to try to do this yourself, gosh, at least meet with 3 or 4 of them and get 3, 4, or 5 offers. Number two, it's very difficult to negotiate with somebody you're going to marry, and then you want to live in the same house
I'm glad
and
you
be an
mentioned that.
asshole when you have to negotiate, and then be really nice when the deal is done. And it's very, very difficult. And if you don't have the skill or the will to be able to do it, this is why you get representation, right? And I just tell you, I think it can make a huge difference. But I wouldn't just take one random call. If you're going to go to market,
No.
have either shop a half dozen, shop 10 companies, get a bunch of offers, start to compare and contrast them.
Yeah, I think to your point, there's just no way that you negotiated that deal well enough if you still want to work with them, right? Like you either left money on the table or you put a bad taste in their mouth, and now they're not going to work with you. So you've got to bring somebody in. Got a couple questions coming in, Ted, on the chat. Casey asks, "What's the impact of organic growth rates on multiples?" I mean, that's really a night
Yeah,
and day,
so
isn't
I
it?
would I would tell you that if you ask me the single biggest lever to increase the multiple in your practice, that would be my answer. That you can prove that you have an organic marketing engine. And I want you all to think about why that's so powerful, because it's the biggest defense against a downturn in the markets.
Yeah.
So the markets have been rocky here as of late. Imagine the markets go down 20% this year. When I owned Oxygen, I really didn't give a shit, because I knew that brand wise, I was going to take business from other people. And two,
Yeah.
I could acquire a whole bunch more clients because I was a marketer. It's not your money management. It's not your brand. It's not your planning systems. It's not any of
Nope.
that stuff. The number one factor for increase in multiple is organic marketing engine.
Yeah, and it really doesn't matter what the source is. They really just want to
Oh,
see that you're growing, like year over
I-
year, and it's net growth, right? Like they don't give two craps about growth of the markets, right? Because again, that's all going to wash out the
It's
same.
6 and 1/2 dozen the other, but they don't care if your marketing source is like your Joe community college retirement planning guy, or you've got a YouTube channel, right? Who cares? If you can prove that you have a methodology to bring in clients on a regular basis, you can do it.
Let's talk a couple more. Organic growth is a major driver. Kyle asked, what about some of the other non-financial factors like having a next gen person in place or your processes? What are some of the other big levers that change the valuation or practice, or is that just really a matter of matching the right buyer and seller?
So, having a next gen helps quite a bit, right? Because if you think about it, if I'm buying this business, my number one question are the assets sticky, right? It doesn't help me to buy you and have the assets leave. So the next question after that is, if I buy the assets and you leave, what makes the assets stay? So having a generation two is extremely helpful for that very reason. And that can increase the multiple. Geography can increase the multiple. If you're in an
Interesting.
area that they want to be in and you have a great practice that can act sort of as a platform, That can be very valuable, or you may be in an area where that company's choosing to dominate and they want to acquire more, and that can make the practice valuable. The time that you're willing to stay, if you're willing to stay for 5 years or more, that can make the practice very valuable, right? When you want to leave in a year, it can be much more nerve wracking as to what's going to happen to the assets. But like your planning process and like your software stack and all that stuff. I mean, listen, I spent a lot of money on my brand. I'll tell you all that.
Yeah,
I'm not saying in the end it was worthless because it helped my organic marketing, but
for
when I'm in
sure.
there like, hey, I'm McDonald's, you ought to pay me more for the brand. They were like, yeah, it's not going to happen.
Yeah, they don't really
So,
care about that.
I
Yeah.
just would tell people, I appreciate that you really love your brand, but it's not going to intrinsically move the needle.
Pull on another thread there, Ted. You mentioned, hey, what's your plans going forward? This is something you and I worked on extensively when you were helping me sell my practice, which is what is your plan, and can you clearly articulate that to potential buyers? Right? If you show up there and you're like, hey, listen, I just want to smoke cigars and bullshit all day, well,
Yeah.
that's a lot different. So talk to us a little bit about being clear on that before you go to market.
Yeah, I want to mention two sides of this. One is, why don't you do your own financial plan? I can't tell you how many advisors talk to me and they say, what's my ongoing comp going to look like? And I go, it's going to look like this. And they go, I can't live off of that. Well, that's pretty scary. You're planning for your clients. If you're
Yeah.
making 400 grand a year and you're like, I can't live off of that. I got 2 wives, 2 boats, 9 kids, I mean, whatever it may be. But I think what you want to be thinking about is that if you do want the escape hatch to get out of it, you want to have clarity around that escape hatch, i.e., like, I need you to find me a successor, or I have a successor and I'm willing to work the next 18 months to transition the client relationships. Like, nobody wants to hold you up in the business. But again, remember, what's the motive? How are the assets sticky? And as long as you have a game plan to prove that you can keep the
Mhm.
assets sticky, you're going to be fine. If you don't, it's a little bit more precarious and that can make the price go down.
Well, here's one on the opposite kind of extreme here. We got a question here from Casey. What if a guy does just want to cash out and go? Like how do those deals look? I mean, what about the earnouts? How would that look?
Yeah.
Or is that kind of a deal killer?
No, no, it's not. It's not a deal killer at all. You can still get decent multiples. They may ask you to take some stock, even though you won't be in the company anymore, so you still have
Sure.
like a back vested interest. But I would probably try to negotiate as much cash as upfront, and then a rev retention number. 6 months may be too short. It's probably going to be more like a year.
Yeah.
And, even if you're basically like, lackadaisical in the background, I would give them at least a year
Yeah.
just so they know that the relationships have transitioned.
Yeah. Because again, Casey, and for everybody listening, like these are businesses that want to grow businesses. They're not just like handing out
Yeah.
checks for fun, right? Another one here from Terry. Terry, thanks for being here. You can comment on multiples if it's a lift out where somebody's going to be switching platforms or moving from
Yeah.
Jones to wherever or Ameriprise or whatever's going on there.
Not as much as you would think. Having done a lot of these deals, what you'd assume is like, let's use something in the industry right now. Huge shakeup this past week in Commonwealth, right? Now, Commonwealth is going to become part of
Wow.
LPL. Here's how this is going to go down because I've heard advisors have been calling me, Jarvis.
I bet.
You're doing $1 million of revenue. Commonwealth or LPL offers you an 8-year note. And I'm not saying it's a crappy note. I'm just saying it's a note for a couple of $100,000 to stay for 8 more years. Right.
Eight
And you're going to
years.
have a choice, right? Because even if you don't have to repaper and they give you negative consent, eventually you're going to be an LPL RIA. And LPL is a fine company. They really are.
Great
But you have
place.
a choice to say, do I go into that deal or is it time for me to go shop the market? Okay. So either way, what I can tell you is if you're pure RIA versus IBD lift out, if you will, the multiple might change by like a half a turn. It's
That's
not,
it.
it's not
Wow.
dramatically because in the end, you're going to be responsible for moving the clients. Where it gets more difficult is if you're at a bank or you're at a wirehouse and you've got a
Mhm.
contract. I'm not going to name names, but there are a couple of firms that basically have a firing squad, and they'll
Yeah.
shoot every legal manner possible to try to mess with you. These are the things that you want to think through. What does my contract say? Am I in protocol? you know, who owns the data, that kind of stuff. But it's not as materially much as most of you would think on a lift out.
Yeah. And there's kind of an order of operations there too, right? If you're there's people that specialize in lift outs, right? Like that is their jam, and you want to be really careful. I think Ted, to your point on the firing squad, I had a friend. She worked for a major firm. Again, we won't name it. And her job every Sunday, she got a call from the firm saying, "Here's where you're going," because an advisor quit or was fired or is leaving, and she would fly out every Sunday afternoon and run that office
Yeah.
until they to capture all the assets. And she would spend all week capturing all those assets. Meanwhile, the legal team is firing everything they can.
You know,
So
the other piece of this that I find funny in our industry today is some advisors I talk to, I say, you know, are you RIA? And they go, oh yeah, I'm RIA fee only. And I go, oh, okay. And then like 5 minutes later, they'll go, well, my RIA isn't really my RIA.
yeah,
I'm kind of a representative of this RIA, and it's like, well, look, you think you at a broker dealer where you are an IAR of an RIA is any different if you're with an RIA only, where you're still an IAR of an RIA. So the question is, what's your contract say?
what's your
In the end, I'm going
yeah.
to tell everybody on here, I'm not asking you to become a legal scholar. I would advise all of you now, just read the details of the contracts, because whatever you've done, eventually you're going to have to undo down the road.
Yeah, you will.
And
Got it. Oh,
and
go ahead. Sorry.
Jarvis, one other thing, if you're building your own
Yeah,
RIA and like you're younger on here, just do negative consent in the RIA now. It's much
yeah.
better than having positive consent. A lot of advisors I asked have their own RIA. Do you positive or negative consent? Oh, I got no idea. And it's like, well, kind of makes a difference.
Kind of makes a difference. For all of you listening, if that phrase isn't doesn't ring a bell, negative consent is that means that clients have to opt out. So if you want to change and it's negative consent, the client would have to say, "Hey, I don't want to do that." Whereas the default is positive consent, where they would have to say, "Yes, I specifically approve that happening." Question from Wes coming in here. Wes, thanks for being here. Sell side advisors seem to charge anywhere from 2.5% to 6%. Wes, I think the range is a lot bigger than that for a success fee on these deals. Do you get what you pay for? Wes, I'm going to jump in before Ted does. I got a car for sale for 20 grand. Is it a good deal? Like, it's really going to depend on what you're getting. I've
Yeah.
seen Ted, you and I have talked to guys that paid low success fees and they did not have success. And I know guys that paid high. I mean, I wrote you an enormous check as part of my deal. It was the best check I've ever written. So, Wes, I'm going to say it depends on who you're getting. But Ted, jump in here, man.
I mean, I agree. I mean, I would never personally do a deal for 2.5%, so I could tell you that. But I'm not saying somebody else would, but I think in the end, you get what you pay for. You know, I would question somebody's experience, not just like as a broker, but how many deals have they done in this industry?
Yes.
Okay. How many buyers do they have? And let them show you some redacted contracts of deals that they've done before. And just see if they're legit, but again, you get what you pay for. I would never be penny wise and pound foolish, meaning that,
Mhm.
you pay somebody 500 grand, $1 million, it could be $3 million. I mean, I finished a deal in the public insurance adjusting space. I made $4 million. Okay. You could be like, hey, you're not worth 4 million. Well, I got them 100 million. And the owner was telling me if they had got 80 million, they'd be thrilled. So I got them 20 more $1 million than they expected. Yeah, I'm worth 4 million bucks.
Yeah. Plus all the other terms in the contract that we've alluded to earlier. Yeah. So they essentially, if we boil it down, they paid 4 to get 20.
Yeah.
That's a pretty good deal. Wes, I have seen other groups that I've talked to advisors like, man, I've been paying this success fee in this contract and it's been terrible and now I can't get out of it. Like it's not
Yeah.
consistent across the board. Like any professional, I want to talk to somebody who's used them and can recommend them.
Jarvis, two other thoughts on here.
Yeah,
Sometimes we
please.
see sell side advisors and they say, well, I only charge a success fee of 3%. It comes with you having to put down a $10,000, $50,000 retainer. You
Yep.
may have other extraneous costs. I've always done my deals where I only get paid if I get it over the finish line. Right. I wish there was a way to do that in our business. I know it's hard to
Yeah, no
charge
kidding.
performance based. But imagine telling clients like, hey, your best deal, you should never be paying more than 5 basis points and go index at Vanguard. None of us would want that. It just seems kind of silly. Why would you pay a guy 1%?
Yeah. Yeah.
And in the end, hopefully they're not only paying the 1% for your expertise, but over time, you're going to manage their emotions, which is not de facto what happens in the portfolio,
Yeah.
right?
Yeah.
But it is, because if they pull out during these times, as you know, they can make a huge mistake. Remember what happened during COVID? How many people probably pulled out on their own? The advice of you telling that person just to stay put is invaluable.
Totally makes sense. I got a question from Brian here. 10 years away from selling. I guess this is just general business advice, like longer
Yeah.
term guys mid-career. Though, I guess quick sidebar here, Ted. You told me the other day, correct me if I remember this wrong, that like the average seller you're working with is in their 40s, not their 70s. Do I remember that right?
It's true. I would say it's in the higher end of the 40s range right now, because this becomes a different calculation, folks. You know, like y'all can run spreadsheets. I bet a bunch of you live in Excel and stuff like that. But, you know, if you're making $1 million a year, here's a simple analysis, right? Which is, if you got 10 million bucks today, even if you were on a lower payout, and you believe the stock of a company was going to run like you saw a creative planning stock run, where would you have more money in 15 years if you had the same exact growth rate, the same exact rate of return on your money that you invested? Where would you be? And I'm not going to answer that for you. I would just say, you know, do a little math exercise. Now, if you're really 10 years away from selling, couple thoughts. One, make sure that you got your legal house in order today. I can't tell you how many advisors have 1099 contractors, or that the practice is built legally on a house of cards. It makes it very difficult. A good example is like, do you own your own building? Yeah, I do. What do you charge yourself for rent? Well, I have people that charge themselves crazy amounts of rent, or like no rent at all. It just depends on like how they build out their LLC. But, you know, the company that buys you is only going to pay market rent and a lease back. So you kind of have to make that look operationally too. Whether you do it yourself or you hire somebody, get a set of QuickBooks or get a set of books, period, right?
QuickBooks,
Regular P&L that you not only can show what you probably cheat the government on. I'm just kidding. But also
theoretically,
the real cash flow is in your business. 3, build an organic growth marketing engine. You have a way to build an engine. 4, get yourself indoor cats. What I mean by that is, if you're the outdoor cat that basically does all the BD for the business development, make sure that you've got generation 2 or indoor cats that can service those clients. I like the term outdoor cat and indoor cat because of those are the 2 types of advisors we have in the business. Some people like to play at the computer, watch CNBC, watch the stock market. I'm not telling you they're bad advisors or it's a bad job, right? They're just not BD people. And then there are people that have big, thick claws and they know how to bring in business. They're the outdoor cats. So you have to make sure you've got a team in there. And then last, operationalize your systems, policies, procedures, asset management. The better the business works like a Starbucks, I think the more value you will have over time.
No, that totally makes sense. Ted, we got time for one more question, and then we'll give everybody a call to action, right? How they can get better information. Casey's got a great question. I think you already alluded to some of this. Interest rates, market downturn. Like, are you seeing any deals that are blowing up right now because of the markets? Are you seeing buyers like, hey, listen, I don't want to buy anything?
Number one, no. I said this before. People are confused. It's not interest rates that factor in the size of a deal right now. It's the expansion or compression of multiples on the top end of the RIAs in our business. So if creative planning, Mariner, Mercer, Edelman, Fisher, if they all go down to an 18 or 17 on multiple, we'll get compressed as well. If they stay up in the low 20s, I would call it like 21 to 24 on the multiple, then we're all going to continue to get paid for a while, right? I don't really believe interest rates are playing a factor in that right now. What would matter more is if something massively changes in the business that compresses the cash flow that comes out of the business, right?
Some regulation change, something,
So I don't see that changing at all, to be honest with you right now. I mean, I haven't experienced it, and I'm in it every day. And here's one other food for thought. You know, when they always tell you to follow the money, a lot of you don't follow the money as advisors, but all private equity companies need to put their capital to work, right? You can't return a 30% IRR by having money sit in a 4% money market account.
No. Huh.
So if WEG, as an example, which is the number 5 or 6 RA in the country, they get a slug of capital for 300 million. That's the time to strike for a deal because they got to put that capital to work, and they tend to slightly overpay. I'm not
Mm.
telling you they're a drunken sailor. I'm just telling you they're buzzed. And so, they got to get that cash to work, and that's just the reality. So follow the money.
Yeah. No, that makes a lot of sense. Again, I think back to Wes's question about is it worth finding the right sell side advisor, and even just knowing who's buzzed right now, Ted, to use your analogy, makes a big difference.
Oh,
Awesome.
I
Well,
know who's had
so
a
please.
cocktail at the bar right now.
Yeah, yeah, you do. Which we'll chat about another day, like how you develop that list. I just back to outdoor cats, right? Just out there and beat the streets. But for everyone who joined us, thanks for jumping in on our first live stream and your patience with the technology. If you go to theperfectria.com/JPTD, I put the link in the chat. I'll put it in here again. Ted's team will do a kind of street level analysis on your practice. So you can put in your information, and Ted will say, hey, based on the deals we've seen, here's what you can expect, and here's what your next couple of moves are. That way, back to our earlier comments, if you joined us late, facts versus fallacy, Ted's just sharing what he's seen. Somebody can argue with that later, I guess.
I mean, I guess if you can argue with numbers, I mean, but I can show you signed deals, and kind of hard to argue with them if they're recent and relevant.
Yeah. I think, boy, not to get too far off on this, I think some of this confusion comes from the old school mentality and then like bank valuations, right? Like if you're trying to get the bank to lend money on your practice, they're going to have their own formula. They're not going with what the deals Ted's seen. But unless you're selling to the bank, I don't know why that matters.
No, I mean, I saw this recently with the roofing company. Most roofing companies might trade at a 4x to 6x on cash flow. And I got a roofing company at 9x because of geography and the whole deal. A bank would have never bought it at a 9x or loaned on a 9x. It's just not the
No.
way it is, but that's what they got sold for. So I don't judge the market. The market is it's the ever clear mirror all the time. It will always tell you what things are worth.
Yeah. Boy, we'll take this last one from Kyle. Kyle, go ahead and go to the perfectra.com/JPTD, put in your information. And then Ted, he's asking,
Yeah.
hey, can I see redacted deals? This has been something you've been willing to do in the past. If guys are serious, like don't waste Ted's time. Like if you're just like sitting at your computer and you're like, hey, I wonder what Ted's up to, don't waste his time. But if
Yeah.
you're serious, put in your
That
information.
For Kyle, put in a form. We got to get an NDA because obviously we like to keep things confidential for many, many reasons, even though we do
Yep.
these podcasts and I share a lot of stuff. And happy to show the skeptics some deals. And it's I don't think it's more complicated than that.
I love it. Hey, Ted, thanks so much, man. Pure gold as always. For everyone listening, again, go to theperfectra.com/JPTD. Ted, we will catch you next time.
All right. Thanks.
Thanks, brother. Take care. Awesome, dude. Yeah. All right, we are offline. All right, we'll have a recording of this too.